Hello, students. In this knowledge module, we'll talk about the profitability ratios. So we have a simple learning objective to understand and interpret different kinds of the profitability ratios. And as we go along these slides, you will see that how many profitability ratios are there. So under the umbrella of the ratio analysis, one of the analysis which you need to conduct is the profitability ratios, and the investors and the other user of the financial statements, they want to see that how good firm is doing when it comes to the profit generation. These numbers can actually impact the stock prices, but this is only one factor. There are many unique situations as well. And from these ratios, the investors can shape up their opinion. Plus, there could be other news as well. So usually when the stock prices jump or they go down, like it is not only because of these ratios. Like there is some like the surprise element that comes in, which may not be represented by these ratios, and that can jump up or decrease the prices of a stock suddenly. But this is a part of the calculation of the or computation of these ratios is a part of the fundamental analysis. And if you are a long-term investor, then these ratio will actually help. So if these ratios are positive, then it shows that it's good to invest in the company. But given the situation that if you want to invest for a longer period of time, because eventually the fundamentals will work, and the news when the news come, it impact the prices over a short-term basis. So let's move ahead and see what are those profitability ratios. So first of all, we have the gross profit margin. We need to understand that there are three levels of profits. First is gross profit. When we do the sales, we subtract the cost of goods sold, we arrive to the gross profit. Then we have operating expenses. We have to give the salaries to the administrative staff. We have to conduct so much operational expenses. So the expenses which we incur while conducting the operations, those are the operating expenses. We have to subtract them from the gross profit to come to the next level of the income, which is the operating income. And from that operating income, we pay the interest on the debt, and as well as we need to pay the taxes to the government to come to the third level of the income, which is the net income. And we want to see the relationship of those incomes first with the sales, but with the sales, it is not only important. We also have to check their relationship with the total assets, and I will elaborate this thing later on in my knowledge in this knowledge module. So first of all, we are at the first level of the income, which is the gross profit. If we divide the gross profit with the total net sales, we get the gross profit margin. This is a ratio which suggests that how much percent of the total sale company is getting in the shape of the gross profit. In other words, from each dollar of sales, how much company is saving as gross profit. So I'm using the data for the Lululemon from the fiscal year 2019 statement, which were issued in 2020. And this is from the 10K. This is the annual data. And this ratio, as we see that it established the relationship between the gross profit and the net sales. So the interpretation is simple, that 56 cents from every dollar of sale Lululemon is saving in gross profit, and rest 46 cents they are actually like spending under the head of the cost of goods sold from each dollar. So it means that the fixed 56% of the total sales of the company is getting saved as the gross profit. Now, over the period, if this ratio is increasing, it's good. It's a good sign. Higher this ratio means that your cost of goods sold is less and you are actually having more gross profit at the end of the day. But it should not be considered alone because it also depends that if you're keeping such a high margin from your sales, high margin as a under the head of the gross profit, so you are keeping much more profit after subtracting the cost of goods sold, might be you are basically doing less sales. Now, where many retail stores, for example Dollarama, they actually depend on the asset turnover. They try to sell their inventories very quickly, so they keep that gross profit less, that the margin out of the margin out of the sale, they keep it less. So it means that they have high cost of goods sold, and the margin which is getting saved under the gross profit, it is less. But where they are getting the benefit by selling more units which are available on their shelf. So in that way, they might end up generating more profit. So let's see an example very quickly over here. So one thing, that the profit cannot be only considered in relation to the to the sales, but also in relation to the asset turnover. So for example, there are two companies, company A and B. So the total assets of both the companies are 100 millions each. So 100 million asset company A has, and company B also has 100 millions of asset. So why we are doing it? In order to do apples to apples comparison, rather apple to orange comparison. Now, if the gross margin is 50% in company A and 35% in company B, it means from each dollar of sales, company A is spending 50 cents under the head of cost of goods sold, and rest 50 cents they are saving as the gross profit. On the other hand, company B has less gross profit, because they might have a strategy to sell more of those units by squeezing their profit, and they are trying to shift their some saving to the consumer, so that they have an incentive to buy more. So out of each dollar, only 35 cents are saved after spending the cost of goods sold by company B, and rest 65 cents are spent under the head of cost of goods sold. Now, because of this strategy, might be the company A has less sales and company B have more sales. So the total sale for the company A is now, say, 200 million, and company B is 300 million. So this will lead us to a situation where the gross profit in relationship to this total sales for the company A is 1. So we are dividing the gross profit for company A, which is obviously the 200 million minus the 100, which is the cost of goods sold. So the rest is the 100, which is the gross profit for company A, and that will give us the 50% gross profit margin for company A. So this is 1. So this is suggesting us, so I simply have divided this the gross profit with the total assets for company A. It gave me 1. So for every dollar invested in the total asset, company A is generating $1 under the head of gross profit. For company B, situation is a bit different, even though the gross profit margin is 35%, but for the company B, when we are calculating the gross profit in relation to the total asset, it is 1.05. So 105 is the gross profit, because they are generating more sales, divided by the 100, which is the asset of the company B. So for every dollar invested in the asset of company B is generating $1.05 under the head of gross profit. So this emphasizes that we should not consider the profitability only in relationship to the total sales, but also in relationship to the total asset. So the asset turnover is important when we'll be considering the profitability, because some firms, as I mentioned earlier, in some industry, the profit margin is less, but they end up getting more profit because of the more sales, and they turn over the assets more efficiently. Again, for this ratio, we need to see the trend, and we need to see that what is the average of the industry. If you do not have the industry averages available, first preference always goes with the industry averages. But if it is not available, then compare your average with the last compare your ratio of the latest year with the average of last 3 or 5 years. If 3 years data is available, that's fine, of your closest competitor. Again, the industry average is more important. If that data is available, use that. Now, for the operating profit margin, now we have come to this next level of the income, which is the operating income. So after subtracting all the operating expenses from the gross profit, we are arriving at the operating income, which is EBIT, earning before interest and tax, and dividing it with the net sales. So again, this is the data for from the Lululemon's fiscal year 2019 annual reports, and those were issued in the February 2020. And if you see that, again over here we are establishing the relationship between the net income, the operating income, and the net sales, and this ratio is suggesting us that 22.34% of the total sale company is saving under the head of the operating income. So after paying all the cost of, after meeting all the cost of goods sold expenses and the operating expenses, this is what company is saving. But from this, they still have to pay the interest and the taxes. So in other words, from each dollar of this of the sales, 22 cents on an average they are saving under the head of the operating income, after paying all the operating expenses and meeting the cost of goods sold expenses. Again, higher the better, but should not be considered alone. The asset turnover is important. So profitability must be considered along with, in relationship to the asset turnover, and not only the sales as well. Again, check the industry averages and check the trend, that whether over the period these numbers are increasing. It is good that if the trend is positive, it means that company has squeezed down the operating expenses and maybe the cost of goods sold for some reason. But it is not always to have that cost of goods sold should be squeezed a lot, because this shows that there is a lot of margin, and maybe if there is a lot of profit margin, it will maybe reducing the sales, because if you are keeping your sales prices very high, that can be that can go against the strategy of increasing the sales. So incentive is not there, consumer might not buy your product because of excessive prices. Then we have the third level of income, which is the net income, and this will give us the net profit margin if we divide the net income with the net sales. So 16% for the Lululemon, suggesting that from each dollar 16 cent company is saving after paying all the expenses, including the interest expense and the taxes as well. So 84 cents they have paid under those heads, and 16 cents they have sent from each dollar. Or in other words, if we'll see the percentage interpretation, then 16% of the total sale company is saving under the head of net profit margin. They again, higher the ratio is better, and we again need to check the industry trend and the company's trend for this ratio, and we need to compare it with the industry averages. The fourth ratio is the return on asset, very popular. We are dividing the third level of the income, which is net income, with the average of total asset. The average of total asset means that what are the assets in the latest fiscal year and what were the assets in the last year financial statement. So that is why it's not the average of say 3 year if you are considering or computing the ratios for the 3 years for the company. So this will give you the average of the total assets, and the 24% suggesting that from each dollar of investment in the asset, Lululemon is generating 24 cents every year and profitability under the head of net income. The return on equity is suggesting that how much the investors are making, and this shows that 38 cents investors are making on an average if they have invested $1 in the company. They have invested $1 in the company. Now remember, this is the book value. If you are investing at the market rate, so whatever is the share prices right now in the market, this will not be the ratio for you. So this is for those who have invested in the at the book value. So we are considering the book value over here for the total equity, and again we have taken the average over here. Now if you see that there is a difference between the return on asset and return on equity, and for the investor, return on equity matters the most because this shows that how much they are getting for what they have invested in the company. In this case, it's a Lululemon again, and I'm using the data from the fiscal year 2019, right? This will show that how the debt can impact your return on equity. So there is a company whose asset is 100 million. Say all these numbers are in million, right? So 100 million Canadian dollars. Operating income is $10 million. The cost of borrowing is 8%, and the tax rate is 25%. So there are three scenarios. In the first scenario, they have not taken any debt. In the second scenario, there is 50% debt. So it means that the 100 million of asset, 50 million is financed by the equity, and the rest 50 million is financed by the debt. And in the third scenario, 90% of the total asset is financed by the debt. Means 90 million in the total asset is financed by total asset of 100 million financed by the debt, and rest 10 million is basically invested by the equity holders. In the first scenario, interest rate is 0, tax rate is 2.5%, net income is, if you see over here, 7.5 million. So the return on asset is 7.5, and the return on equity is 7.5. And both ROA and ROE is equal with 0 debt in this case, right? Come to the second scenario. If we'll go ahead with the second scenario, where we have a 50% debt, in that case, our net income is 4.5 million. And how did we get it? We simply have to first calculate the interest. So interest is basically 8% of the 50 million borrowing. Remember, 50% of the asset is financed by the debt. So if we see that 8% of 50 million will get 4 million in interest, we subtract it from the EBIT, will come to the EBT, and then we will need to pay on that EBT 25%. If you see that in the second scenario, interest is 4 million, as I have just mentioned, and tax is 1.5 million. So the 1 million tax has reduced from the first scenario. So we can say that a part of the interest payment is financed actually by the government, because now they are receiving less taxes. So that's why the interests are tax deductible. right? So this is actually reduce the cost of borrowing, after tax cost of borrowing for the firm. So 1 million out of 4 million interest payment government has financed. So after tax cost of debt is actually 6%. So 25% of 8%, so tax rate 25% of 8%, this will give us 2%. So if that 2% will subtract from the before tax cost of borrowing, which is 8%, then this will give us 6%. So this is why that we say that the cost of the debt is low, and we want to basically use debt in the capital structure. The companies want to use debt in the capital structure. So look over here, the magic. The return on asset is 4.5%. Obviously, we have increased the payment under the head of interest, but we also use the 50%. Like we also use the 50 million of debt to finance our assets. So 50% of the assets are financed by the debt. So even with that fact, ROE over return on equity is 9%. So this is the magic. We are using other people's money to increase the return of the shareholders. So shareholders are interested in the high ROE. So this is a excellent situation. Check our third scenario. In the third scenario, where we have 90% debt, right? So this is the third scenario. So 90% that means that out of 100 million of worth of assets, 90 million of the assets are financed by the debt. So the interest at this rate is 7.2 million, and the tax is 0.7 million. Compared to the first scenario, 1.8 million out of the interest of 7.2 million is now financed by the government. Amazing. So that means that the cost after tax cost of debt is low. So in this situation, net income is 2.1 million. The return on asset is 2.1%, and ROE is 21%. Now, if this is the situation, why the industry average could be 50%? Say if we have a company, I know this like this is actually not the number from the Lululemon. That's important to mention. I just created this number, and if the industry's average debt ratio is 15%, the reason is that there could be high risk as well when we start using the debt a lot, and then we have to pay a lot of interest. Like in the third scenario, we need to pay 7.2 million of interest. If the operating income of 10 million Canadian dollar is stable, then it's not an issue. But most of the industries, most of the are cyclical in nature. They are seasonal. Their sales are seasonal. Sometimes they can go up, sometimes they can go down. In that situation, the company is exposed to a very high financial risk. And this is the reason why there is an optimal level of debt in the capital structure, which we also say that optimal capital structure, that what should be the what would be the composition of the capital structure, what would be the debt in the capital structure, and what should be the equity portion in the capital structure. So if you go with the example of where we can predict the future cash payments and the revenues very easily, which are more stable. For example, utilities companies and even telecommunication companies like Verizon, AT&T, because people will use their services. So in that case, they have more debt in their capital structure. But if we will look into companies, say Apple, the Apple credit rating is very high, but relative to those communication, relative to the utilities companies and the other industries, they have less debt in their capital structure. So again, it depends that what sort of industry in which the company is operating, and that will determine the level of debt which the company will take or the level of debt they will with which the company will use to finance their assets. Sorry guys. Now change the number. What about if the cost of borrowing is 10%? Now with the cost of borrowing 10%, in the first scenario where there is zero debt, both ROA and ROE is same, no surprise. So again, whenever there is zero debt, ROA, return on asset, and return on equity will remain same. In the second scenario, when the ROA is 3.75, the ROE is 7.5% again. And in the third scenario, when the 90% of the asset is financed by the debt and the cost of borrowing is 10%, then ROA is 0.75% and ROE is 0.75% and ROE is 7.5%, right? So this actually, if with the change of the composition of the debt, we will keep getting the same ROE, but ROA is getting changed. This shows that we should not impart any debt if the rate is more than 10%. And we can see that with an example over here. Why? Because if we will have more debt, it means that the after tax cost of debt will be more than the return on asset when there is zero asset, when there is zero debt. So let me show you with the numbers in the Excel file. So this is the Excel file. If you see, I will change this debt to 50 because 50% of the asset is now financed with the debt and the 50% of the asset is financed with the equity. We know that this is the ROE, and ROE is not getting changed in this situation, 90. So this is the same thing, but interest rate is 10%. What is the after tax cost of debt? So 25% of 10%, it will give you 2.5%. Subtract that 2.5% with the 10% interest, you'll get 7.5%. So when there was zero debt, if your when there is zero debt, if your ROA is equal to the cost of after tax cost of borrowing, which is 7.5%. Why? Again, 25% of 10%, which will give you 2.5%. Subtract that 2.5% with this interest, 10%, you will get the after tax cost of debt, which is now 7.5%. If with zero debt, your ROA is equal to after tax cost of debt, that is the limit. Your interest rate, if it will go up, then it means you will start contributing from your return on assets more toward paying the interest, towards paying the interest payments, and you will start squeezing your ROA. For example, if I will change now this interest to 12%, right? So it means that my after tax cost of debt is now 9%. 25% of 12% is 3%. Subtract that 3% with by 12%, you will get 9%, right? So in that situation, if I now have 50% of my asset financed by the debt, look how the numbers change. Can't you see that ROE decreased from 7.5% to 6%? So it's squeezing down, still higher than ROA, but it started squeezing down. This the investors do not want. They want ROE high, right? And with the 90%, check. Now ROA is minus like 6%, right? And what is about ROE? More loss, right? Like minus ROA is actually minus 0.6%. ROE is minus 6%. So more loss. So this consideration to the interest rate is very important. Your after tax cost of debt, you need to compare it with the ROA or historic ROA for the company when there is no debt, right? In that case, in a simple way, what I'm trying to say that it's good to have debt in your capital structure, but there is a limit to that, and important consideration should be paid to the what is the interest rate. In our scenario, where the interest is simply say 8%, right? Everything is looking fine, right? And normally, if you see where the commercial loans and based on the good, because most companies, big companies, in which the investor wants to invest, they usually have good credit rating, and they have access to a low cost financing, and especially under this prevailing situation where all the economies wanted, like all the government wants to jumpstart the economies, and the interest rates are already very low. So that is not an issue, but you need to understand that this is not always beneficial. It depends that like what is the interest rate also as well. Finally, we will go and conduct the DuPont analysis. We know that the ROE is the net income divided by the average total equity. And if we algebraically rewrite this, we can write it as net income divided by the net sales, multiplied by the net sales divided by the average of total asset, multiplied by the average of total asset divided by the average of total equity. So in the numerator, total assets can cancel with the total asset in the denominator. Likewise, the net sales in the numerator will get cancelled with the net sales in the denominator. All we will be left will be net income in the numerator and the average of the total equity in the denominator. So it means that ROE can be increased based on these three ratios as well. What is the first ratio? Net income divided by net sales. We just have covered it. It's at the final level of the income, net income divided by the net sales. So this is actually the profit margin. Then what is this? Asset turnover, net sales, how much the each dollar invested in the asset, how much sales it is generating. So net sales divided by the average of total asset. And finally, what is this? Equity multiplier. This ratio will show us that how much the proportion of the asset is financed by the stockholders, right? If this number is high, it means more debt has been taken to finance the asset, and less equity is present in financing the asset. If this is low, it means that more equity is used to finance the asset. So for the Lululemon fiscal year 2019, the 16% is the profit margin, multiplied by the 1.48, which is the asset turnover, multiplied by 1.58. It means that every $1.58 of asset out, like $1 is financed by the equity holders or shareholders, and rest 58 cents is financed by the creditors, right? We know there is no interest bearing loans over there, but there is a short-term creditors as well, and there is like different other creditors who are financing the total assets. And RO is 37.41% in this case. So if we want to increase the ROE, we can increase either the equity multiplier for the Lululemon, then or any company, or the asset turnover, start generating more sales from the given assets, and or starting having more profit from whatever sales. So whatever we are selling, more percentage of that sale we should save under the head of net income. Let me show you the Excel sheet for this one as well. So you see that over here, this is the gross profit margin, operating profit margin, and net profit margin. Like in all these ratios, I have seen that what is the relationship of the different level of profitabilities, like gross profit, then operating income, and finally the net income in relation to the total sales. And then I also tried to see that what is the operating return on assets. So operating income divided by the average total assets, that is actually the 33%. So in other words, every dollar invested in the asset, it is generating the operating income of 33%, right? Then I have return on assets and the return on equity and equity multiplier as well. And if I'll multiply the net profit, which is this one, 25, if you can see that. So just give me a second. This one over here, 25. If you see this one, this 25, so 0.6 multiplied by the total asset turnover, which is the ratio number 16 over here, which I calculated, 1.48 multiply by, then I finally multiplied it with the equity multiplier, which is 1.58. So you can see that D33 multiply by D20 multiply by D37. So it gave me actually 0.38. It is different than the numbers given in the slide, but remember might be a rounding off issue. So this Excel number is the most accurate. So 38% is my ROE, which is the same which I have calculated by directly putting the net income and dividing it with the total of equities, average total equity. So this is the same number. So for the Lululemon, we have seen that 24% is the ROA and like 38% is ROE. But we have used the data for the Lululemon up till the 2nd February 2020. When I'm recording this lecture, this is already November 2020. So there have obviously new operational activities has been conducted by the Lululemon, and they have already issued in between the 2 quarterly statements. So using those 2 quarterly statements, these numbers are the calculated and given on the Yahoo Finance for the Lululemon. This is Lululemon, if you see it over here, Lululemon Athletica. So this number is different and more accurate, 15.44% and 30.75%. But why this number is different than mine? Because my data is basically in the distance past, and that's not the updated data. This is TTM, trailing 12 months. So the last 4 quarter statements numbers have been taken by the analyst, and then that annual statement has been made, which is not representing the fiscal year of the Lululemon, but that will be giving us the more up-to-date data. You might be, or most of the student might be, because it's easy just to download the data from the 10K and do all this sort of analysis on those numbers. But if you want to get the updated results, then you need to take the last 4 quarters and use and out of those 4 quarters you add up the number, and then for that annual year you can compute your return on asset and return on equity. For your class purpose, if you are taking any class and doing the analysis, you keep using whatever you are doing, the annual statements, because it is much easier for you. But if you want to calculate the updated ratios, then you need to use the last 4 quarters and prepare out of those 4 quarters the annual statement and then compute these ratios. Finally, I'm concluding this lecture, and we have discussed about the profitability ratios in this lecture. And the important point which I have made is that the relationship of the profitability with sales is just one factor. You also have to see it in the context of the asset turnover. Might be the company is saving less from each dollar of sales, but in doing so, they are making more sales. And if there is more sales, means there is more asset turnover, then from the collective impact of the profitability can still be very high, right? Number two, when you start imparting the debt, and if your after tax cost of debt is less and your ROA is high, especially when under the situation when there is zero debt, if ROA is high, then the uh, when we are generating the profit out of those assets, we start contributing more towards the return of the equity holders, because our creditors are actually charging very less interest. So having a debt in the capital structure is very important, but there is an optimal level of that debt, and that level is set usually by the industry. I have given an example and I'm repeating it over here. For example, the utilities companies or the telecommunication companies, over there is a stable income and generation of the income. So they can keep paying the debt more easily. So they are less subject to the financial risk. Compared to that, a company for example, which is more subject or in the industry which is very much cyclical and depend on the economic conditions. For example, Apple. If the economic conditions are not very good, might be people will stop buying Apple for some time. So the debt ratios or can be less, and the debt ratios in the or ratio for the utilities or the company in the utility industries will be very high. So these considerations have to be made. But in general, when we actually use debt, we are actually using people's money to generate more profitability for the shareholders. Thank you.